What would happen if the Fed pulled the plug? Could the market actually sustain itself? If history is any guide, we're in for a very interesting future. Even the St. Louis Fed president suggests that we are already too restrictive and need to loosen up. He knows the economy is completely sustained by ultra easy monetary policies and doesn't want to let everyone off the roller coaster just yet. You came here for the truth, so let me unveil that for you. Today we're going to talk about the Fed. We're going to look at the S&P 500. We're going to look at world stocks and connect them together. And I will tell you what happens when the Fed pulls the plug. Let's begin by taking a look at the S&P 500 performance during Fed tightening cycles. This chart, it's a little messy, hard to look at, but I will do my best to explain it to you. And it's very simple. Lesson from the last 11 rate hike cycles. Fed tightening often leads to or coincides with stock market crashes. It is very clear. You can look at the Fed funds rate and you can compare that to the recessions that we have had, and it is very, very obvious to me that whenever they increase interest rates, it brings about a recession. Now you might be thinking to yourself, well, then they just won't increase interest rates. But what do you say about all the previous times they increase interest rates? You don't have a choice sometimes. And of course, there's a fight back and forth. How do we balance it? And so on. The Fed, the bankers, they're always behind. They never foresee this crisis occurring, or at least the results of which. Now, I want to show you this red line right here. That is the current cycle. So just to show you what is on this, the number of months of Fed rate hikes until the first cut. And on the left-hand side, S&P 500 return during the Fed rate hike cycle. So remember, the market has been rising since March of 2009. But it took years and years and years to begin increasing just one time. And so, since that point, according to this, it has increased 41%. If we look in the previous cycles, it's 29% back from 2007 timeframe and so on. So you can look at all the percentages if you're interested. What I would like to focus on here is that historically it is so apparent to me that whenever they increase interest rates, we end up having a problem. Imagine all of the loans, all the banks, the financial institutions that are connected with each other, the insurance, the credit cards, the car manufacturers and car financing, all different types of personal loans, consumer loans, all of this relies on cheap money. And it's the cheapest it's ever been historically. Imagine. Fed funds rate at 0%. That allowed some very, very cheap money to flow through the system. And of course, that brings bad money in. Now we look at that and have to think for just a second. What happens if we're at 0 and we start to notch up slowly, 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 slowly? It doesn't matter how slow they go. Eventually, it's enough to constrict and squeeze people very, very badly. And it's going to affect corporations. It's going to affect states, cities, provinces, countries, corporations, and so on. Okay? All right. MSCI Asia Pac Index, excluding Japan, has fallen to 14-month lows this week. So we had this is showing us from the first quarter of 2016. And it was rising. And we got to this point here. And that is right near the beginning of the year 2018. And the market has come down. And we've seen this being apparent in many other markets. But a lot of individuals constantly say that it's ridiculous and it's a lie to pretend that the market has been doing poorly when it's been rising. And I ask you the question, Which market are you talking about? 7 shares of Amazon. Now look at this here. S&P 500 versus the MSCI ACWI. That's a tongue twister. That is the all-country world index, excluding the US. Okay, so we're comparing basically all countries except the US versus the US. Okay? Look at this. Everything was together. Everything was in sync. Looking at this all the way up. Until we hit that whole VIX issue in late January, and that brought everything down. All together, of course. And it was a bit uncomfortable for a little while here, but eventually the S&P 500 made new highs, and we had the rest of the world continuing to fall lower and lower and lower. So once again, I ask you the question, which market are you talking about? 7 shares of Amazon. Now, when I look at this, I get the feeling that we're in for some contagion to make its way back around to the US at some point. You know, the US doesn't have to be the first domino to fall for it to fall. We're looking at China's market being down 25%. We're looking at currencies all around the world being obliterated right now. And that's all in 2018. It was that moment, that VIX moment, something so small, and yet did a lot of damage. At least that's what set it off, because everything was just doing so well up until that point. Very unusual. I don't think this is necessarily going to be the trigger. I think we need something bigger to really bring the whole market just down to some event like a 2007, 2008 sort of time frame. However, we can see there's definite weakness. A lot of people have been losing a lot of money here unless they have 7 shares of Amazon, right? So this here is Bullard. He's the St. Louis Fed president, and he made some interesting claims. I think it's worth noting what he's talking about. Handled properly, current financial market information can provide the basis for a better forward-looking monetary policy strategy. He said, and that includes helping the FOMC better identify the neutral policy rate. And this is something that we definitely disagree on. The flattening yield curve and the subdued market-based expectations suggest that the current monetary policy stance is already neutral or possibly somewhat restrictive. Here we are basically at the bottom still, and yet he's suggesting that we're already restrictive. And that, as far as I'm concerned, is ludicrous. We are seeing around the world, no matter where you look, historically low interest rates. And yet, according to him, because he's looking at the flattening yield curve, and that is a warning indicator, but some people don't like to hear it. Yield curve inversions have historically predated recessions, though their telling powers aren't perfect. And that's, of course, you will find that anywhere, all right? Inversions of the Treasury yield curve have preceded the past 7 recessions, while throwing out 2 false positives with an inversion in late 1966, and a very flat curve in late 1998, okay? So this right here just shows us that we should be watching the yield curve, watching all of these indicators to be able to understand what could happen. That's all right? Couple more here. This is just one chart. It's the student loan and car loans put onto one chart, but I just wanted to bring this up simply because we have too much debt. There's too much debt. You can look at it on the consumer level, student loans, car loans. You can see the credit cards doing obviously terribly right now with trillions of dollars and all of this. And then we have, on top of that, the cities and the states and the corporations. Everybody's in more debt. They think it's okay to do this, but we learned the lesson 10 years ago. We learned our lesson 20 years ago, and it's just, you just have to relearn the lesson. Apparently nobody really learns over a long-term span. Debt is a problem. If used wisely, it can be very, let's say, lucrative, but 99% of people don't do that. So we can pretty much generalize and say, if you're going to buy something like a car that you don't need, and you overextended yourself, you bought that house that was twice as expensive as really what you could have handled, then you're going to get burned. It's a matter of fact. This might take you 10 years, might take you 20, might take you 30, but people generally push themselves to the maximum. If they get a big house, they're kind of close to paying it off, maybe, then they get a new job. Suddenly, bigger salary. Hey, I can afford a bigger home now. They buy a home that's twice as big or twice as expensive. Maybe it's in a better area. And now their mortgage just increased. More debt. And that's fine until interest rates increase. And people don't even know that could happen. All right, now that brings me to my last point here. This space available, an interesting article, actually, the way they did it, out of the New York Times. So if you just scroll through here, you get different information. New York City's streetscape has been transformed visually and economically by the staggering numbers of vacant storefronts now dotting its most popular retail corridors. The Times set out with a panoramic camera to capture what this commercial blight feels like on the ground. And you might have seen this for yourself. I've been to New York a few times, seen it with my own eyes. I've been to cities around the world and seen very, very similar situations, and you don't really realize it because you see the flashy buildings and everybody's going to see all these beautiful buildings, but look around and you see a lot of boarded up buildings. You see a lot of plywood being put up in front of these abandoned places, a lot of graffiti. Nobody's been there in a long time. It's abandoned. Probably people have squatting in it and all kinds of stuff. So you could scroll through here and it basically shows you different pictures. It's actually really good pictures that they took. I thought it was interesting anyway, and you could just see how many places all around. They show you, okay, this is Times Square, for example, Williamsburg, and so on. And you could just scroll through. It's not just one or two stores. Hey, that happens. There's always going to be vacancy. But you see it becoming like a plague. You start to worry. And it's in good areas, it's in bad areas, and middle areas. Doesn't really matter. It seems to be pervasive everywhere around. So we've got an issue, and many people would say, hey, that's just retail. That, Amazon is just destroying everybody. But is that why all of the places are closing? Is Amazon replacing hair salons? Is Amazon replacing laundromats? No. We have an economy that's just getting weaker and weaker and weaker. And that's an absolute fact. Too much debt, and it's going to end up biting people in the behind eventually. When? I don't know. You might want to ask Bullard. He seems to know more than me. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. So I do appreciate that very much. And if you want the financial education you were not taught in school, intentionally left from you, well, these two books have it all. You can actually flip through these books at Amazon. If you go to the link in the description, it's going to take you over there where it gives you the look inside feature, and that will allow you to flip through the pages of these books for yourself. If you're more interested in the audiobook version, you can get that at themoneygps.com.